Hey guys, it's Pilot Ben from the Cramson group. I'm going to show you guys how I backtest the Cramson strategy. Before we begin, I want to show you the concept behind Cramson strategy. It's all based off of trades by SI. Trades by SI strategy is very straightforward. It's essentially a break and retest, except instead of it retesting, it slightly goes below resistance. And I guess the idea is if you have buyers right here waiting for that retest, they could get stopped out by the big players. The big players will stop them out, grab all their money, and then have enough money to then push up. Again, this is just a theory. It's a conspiracy theory. No one really knows how the market works. As in Wolf of Wall Street, the saying is it's all a fugazi. No one really knows how the market works. So this is a trades by size strategy. Very simple. Cramson's way of trading it is based off of candles. So let's say we have a candle that breaks out of the previous candle's range. So first of all, a candle's range, all it is the distance from the lowest point to the highest point. So that's a range. So if you break out a range, then what price is really looking like, let's say this is the daily, which Cramson bases his breakouts from. If this is resistance, where price got up here and then pushed down to this level to close, and then broke out of it, well, this is the indication. And then we get below this level, this resistance level, same as this resistance level right here. And then we push back up. And we're looking in this area on the 15-minute for an actual entry. It's really that simple. And the reason why you can get such high risk rewards is because on the lower time frame, it might look like this. On the higher time frame, you might get really high risk rewards. So let's say 15 minute looks like this, and you enter kind of like this. So you're getting, let's say, a 5 risk reward. Now, I'm just showing you this to show that you can get high risk reward trades. But you can also enter trades as little as a 1-to-1 risk reward. That's the minimum that Cramson uses. So I'm going to backtest this on gold. And you're going to see some pairs, they might have some different caveats to the strategy, some small details, which hopefully I'll explain as I backtest. So first of all, I just want to say that I have not looked at gold at all using this strategy. The reason I'm doing this backtesting right now is to really show you that this strategy works on Forex, it works on gold, indices, crypto, everything. So I'll literally click replay. Let me do like April 2025. I just completely chose a random date, but I don't want it to be too far because price action in the last year should be similar to what it is now. So all I'm waiting for on the daily is a candle close above the previous candle's range. Remember, the range is from the bottom wick to the top wick. We close above it. And then I see between, let's say this candle is a soccer goal. Are there any other candles that if we shot the ball, let's say all these wicks are soccer players' feet. If we shot the soccer ball from one of their feet, would it go into the goal without being interfered by another player's foot? Well, with this one, with this wick, yes, right? This player's foot got in the way, so the ball didn't go into the goal. What about up here? Same thing. It's like very close. It's actually pretty much the same level. So yes, it's interfered by this player's foot, this wick. Any other wicks between here and here that have not been met with a wick? No. So this is our only point of interest. So I'll just rename it the point of interest, daily point of interest. Now, here's the thing with the strategy is you have to look at the weekly and the monthly before you take a trade. I do this after analyzing the daily just to see the context. So here on the weekly, We had a break out of the previous candle's range, but then we filled it. And if we go on the daily, let me just see something. Yeah, this is where we have to be very careful, because on the weekly, this is going to be the indication. This is our correction. And then this would be our continuation to go back down. So this is a very small detail of the strategy, and it's good that I'm showing this to you. Is yes, we hit the liquidity on this candle, which is basically the low. But before we hit this liquidity, we never got above the weekly point of interest, right? This is the low, but we never broke. We never got below this line. We never had, essentially, we never had an indication, correction, and continuation to get to that level. What that means is anytime we get below this weekly point of interest, there's a chance that we still hit this new low. So we have to take that into account. So if on the daily we are looking for buys, then we have to be very careful, because if price closes below this weekly point of interest, which is down here, let me why anything under this level has bearish potential, but we're looking for buys above this level. So let's see. Now, thankfully, we didn't get a setup. But let's say on the 15-minute, here's the thing with the entry. Let's say this is our daily point of interest, and we're looking at the 15-minute. We need to see a candle close below, flip ranges, and then close above. What do I mean by flip ranges? Let's say remember, this is the range. So when we're going down, our ranges are going to keep on going down. What we need is for price to close above the candle's range and be above the point of interest. Only then can we enter a trade. So here we didn't get it. The only way I would enter a buy is if we actually never closed below this line. We closed in between these lines, and then we got a range flip and a candle closure above the daily point of interest, because then our rules for buying on the 15-minute would have been met, and we wouldn't be below the weekly point of interest. So I wouldn't have taken a trade on this day. So I'll look at the next day. Right here we close above this previous candle. We also have some wicks that were not touched by any other wicks. And you can really just draw every single one that you see. So all of these are points of interest. Weekly, we're looking for CCT continuation. Replay tool is kind of stupid because the weekly is not going to match what's showing on the daily, which makes it very hard to look at the higher time frames for confluence. So whenever you backtest, you're probably going to have a slightly lower win rate compared to actually live testing. Also, what you're going to notice is you're rarely going to find steps every day on one pair, which is the whole reason you need several pairs. So we're looking for buys. We have a closure below this point of interest. You can draw out rectangles for your ranges, but here we don't close below the range, so we're still This is our range. This is our new range because we closed below it, below the previous range. We closed below this range. This is our new range. We closed below this, so this is our new range. We closed below, so this is our new range. And then we flip our range, so now we closed above this range. So now we are interested in buys because we're also above these points of interest. It doesn't matter as long as we're above any of these points of interest and we have a bullish range flip, we can enter the trade. Now, I want to enter anything less than 1 to 1.5 risk to reward. This trade should be good enough because stop loss goes 2 to 3 pips below the low. I'm using gold, so we don't use pips. So I kind of just visualize it, just, maybe half a candle of breathing room. And then to take profit, it's always going to be the highest point. So zoom out. This is the highest point right here. And then what I like to do as a final measure, just zoom out to the daily, weekly, monthly, just make sure it all makes sense. As a final check, make sure I didn't make any mistakes analyzing the charts. That takes 5 to 10 seconds, and then I enter the trade. Now, if we were at this level right here, I would probably take my stop loss to break even. What you'll notice is with this strategy is once price kind of goes over 50% through your trade, it's very rare for it to go into your stop loss area and then after that jump up and hit your take profit. So that's why anytime after price goes above 50%, I just set my stop loss to break even. And you would have seen that we would have this would have been a break even trade. I already gave you so much value, but we'll keep on going just to show you some more setups and how to analyze the strategy. So this candle closed below the previous candle's range, so we are interested in it. If the candle doesn't close, if the candle closes inside the previous candle's range, you cannot trade that for the day. Just move on to a different pair. Same thing looks good. No continuation phases on the weekly or monthly. These are our points of interest going down to the 15-minute. We're waiting for I need to click this button in the replay tool so that on the 15-minute, we go to 5 o'clock. There we go. All right, looks like we're not going to get a trade today. And so we'll keep on looking on the daily. Our area of interest. This is our area of interest. No continuations there. Counter trend continuations. Let me emphasize that. No trades there. This candle closed below the previous range. Those are areas of interest. Weekly, we are bearish and we are bearish here. No counter trend continuations. Oops, I forgot to click that. That goes to 5 o'clock. All right, no trades that day. Closed above this previous candle's range. This is interest. This is, yeah, those are our points of interest. Weekly, are we in any continuation kind of trend? No, let's see. So yeah, another example is you see this candle broke broke below the previous candle's range and it filled liquidity, but price, let me draw this out with the purple candle, purple line, sorry. Price never broke out, had the indication, corrected above this, and then continued. So that means that if price ever goes above this purple line and then back and then closes below this purple line, it has a high potential to drop all the way back to this level, because that's going to be the weekly setup. It's the same thing that we're looking on the daily, just on the weekly. And the higher time frames are more powerful, so we have to take that into account. So let's see. Daily, we're looking for buys. So this is going to be the correction phase of the weekly, so it's fine for us to take buys. We close here and we just keep on dropping. Now, if you were to enter right here, your risk to reward would be 1 to 1.5. So we could see how this trade works out. $4 o'clock. I mean, let's see. I probably would have closed out, maybe with a little bit of a loss, just because we're just going sideways. And it's 4 o'clock. And let's see what happens. Just for curiosity. Let's see. Very curious. This is a very long trade. But I mean, technically, it should hit the TP. We're still in this trade. At this point, I'm just doing this for fun. But yeah, TP eventually gets hit if you held. I probably wouldn't have held. I would have taken a small loss personally, just because I don't like holding trades for too long. Especially when there's so many other pairs, and even if I made a little bit of a loss, I would have made it back on these other pairs. So yeah, I don't know if you want to count that as a win or not, but yeah, what you can really see though is we don't close below this, so we're still in the trade, and this is, we break out, and we still need to fill this liquidity. So that's why price eventually moves up. And then, boom, perfect example of, look, we talked about how price needs to get above this purple line, and then it's going to drop to this low. Doesn't quite do that, but you can kind of see how there's a large, actually, sorry. This is not our TP. Our TP is based on the weekly. Our TP is this level. So So yeah, we would probably still, if let's say we're taking a weekly setup, yeah, we would probably get stopped out. But I don't take weekly setups. I was just analyzing that for fun. Let's say, where were we? So yeah, we had this push, we filled the liquidity there. And then the next setup was right here. So then we draw our wicks. These are our points of interest. We look at the weekly. Still need to fill that liquidity. So it's 4 o'clock, right? And then this is the next day. So we don't get a setup there. What about here? So candle closure above this wick, this candle, and then we have these two wicks that are not interfered with. Weekly is still fine. And then yeah, I have to click this button right so that the 15-minute goes to 5 o'clock. Candle closure below. We flip the range, right? Candle closure below, flip the range, we're above the point of interest, so you can enter here. Oops. Stop loss, a few pips below, and then take profit is this level right here, giving us a 1 to 2.37 risk to reward. And take profit is smashed. And you can see how this large money comes in and pushes this really hard. I think I'm going to leave it there. You can see the strategy works on gold. Biggest things I can tell you is once price goes above 50%, or even like 70%, I would put my stop loss to break even. You can see that once price is really close to liquidity, it likes to just get there. It's not going to just go up like this and then come all the way down and then go up, really. That could happen time to time, but most of the time you're just safer to just set your stop loss to break even. And that is that.